Okay, well, good afternoon, everybody, and thanks for giving up your valuable time to join us today. For those on the call that I do not know, I'm a tax partner with Grant Thornton, and scarily this year, I've been helping private businesses with tax planning for over 20 years. And I don't remember an announcement during the whole of that 20 years that's had such a significant impact on shareholders as the changes to business property relief, which we're going to come on to talk about today. And that's for shareholders as well as the businesses that they're invested in. I probably had more phone calls from CFOs trying to understand what the changes will mean for cash flow than actual shareholders. And it's forcing conversations which have not previously needed to be had, because actually doing nothing previously was good tax planning. And for some, for the first time, where there's been firm lines between shareholders and businesses, there's now a healthy challenge about what the future may hold. And in some cases, this is forcing people to consider options perhaps earlier than they might have otherwise done. But the good news is, in most cases, with careful planning, there is mitigation. But in some cases, the timeline is tight, and we need to think about that planning before April 26. So I'm delighted to be here with you today to chair as we explore both the tax technical elements of those changes, which Rachel's going to cover, but also the commercial sides from Aaron. We're expecting and we hope that we get lots and lots of questions. So we have saved some time at the end. So please do pop your questions into the chat. I'll collect them all up, and then if we don't have enough time at the end for them all, we will absolutely follow up with them. We've got an hour together, and being a stickler for keeping to time, and I'll make sure that everybody's away within that hour. So we're going to hear from Rachel firstly on the tax technical elements of the changes that I've just described, and then we're going to hand over to Aaron to explore some of the more commercial angles. Then we'll have the questions at the end. So I'm going to hand over to Rachel.
Thank you, Rachel. So there'll be no risk of anyone forgetting our names today. So much like Rachel, I work with owner-managed businesses here at Grant Thornton. I'm a director in the team, but I have more of a private focus. So my work specialises in dealing with the entrepreneurs and shareholders that own that business. And I suppose, Rachel's already mentioned how significant these changes are for businesses. And I was at a board meeting this morning with a client, and their shareholders described this as the most seismic risk to their business in a generation. I mean, to put that into more context, a survey that Grant Thornton did with a number of our CFOs last month put the changes to business property relief ahead of any other tax changes as the biggest risk to their business. And that's in a world where we're looking at in changes to employers' NIC, the US tariffs, R&D reform. This is really top of the agenda as the biggest tax risk facing a number of privately held businesses. So as Rachel said, what I'm going to do to start off this session is to recap on the current rules around business property relief for the avoidance of doubt, talk through the changes and the impact that that has on many businesses and their shareholders. I'm then going to move on to talk about some steps that we are discussing with a number of our clients, from starting with simple lifetime gifting through to some slightly more complex arrangements. I'll come at this more from a sort of shareholder and technical angle, but there'll be a sort of unapologetic overlap between the points that Aaron and I are talking about, and he will add a bit more flavour around the commercial impact and the perspective of other key stakeholders in those businesses. So before we launch into that, we've just got a quick poll. Just interested to know with the audience that we've got here today, the question on the screen: have the changes to inheritance tax rules for businesses created risk for you, or, conscious we've got a number of advisors on the call, your clients? So I'm not sure if we can see the results as we go along, but we can perhaps reflect on these at the end. See where you land, but just sort of.
We can. 57% definitely, 38% somewhat. So the vast majority of people on the call are created risk for themselves or their clients.
Absolutely. Thank you, Aaron. I think you've got a different view while I'm sharing this. Thank you. So given how material this is, I imagine a lot of you have already got a fairly strong grasp of the rules, but let's just recap on the impact and put some numbers to it. So here we've got an example of how the current rules apply today. Mr. A owning 100% in shares in a company, let's assume that qualifies for business property relief in full. Those shares are worth 30 million. This same individual has got other assets outside the business that are worth about 5 million. So like many entrepreneurs we work with, their significant family asset and source of wealth are those company shares. He wishes to leave all those shares and all of his other assets, for that matter, to his daughter on his death. If Mr. A dies between now and next 6th of April, when the change to BPR rules are expected to apply from, his total inheritance tax liability will only be 1.74 million. That's if he does no other planning whatsoever. And that's on the assumption that all of those company shares can pass to his daughter free of any inheritance tax. So what's changing? So business property relief and agricultural property relief will both be capped from 6th of April 2026. I think even people that have nothing to do with tax and don't own businesses are very well aware of these rules as they impact farmers from all the media attention. But it is notable that the impact on trading businesses and lots of these family-owned businesses at the heartland of the UK trading landscape have really not had a lot of media attention. So that business property relief and agricultural property relief will be capped at £1 million for any given individual. That's a combined limit for any assets that qualify for either of those reliefs. Once you've had 100% relief on your first £1 million of value, relief will only be available at 50% thereafter, meaning that for those with notable shareholdings significantly in excess of £1 million, they're going to be assessed to inheritance tax at an effective rate of 20%. AIM shares are also impacted by this, but they are outside the £1 million allowance. So for AIM listed companies, all of their shareholders will be subject to an effective 20% tax on all value attributed to those AIM shares. There's a note here that capital gains tax rebasing still applies on death. And this is where the point that Rachel alluded to at the beginning comes in, because she mentioned that to now, holding onto your shares till death has actually been quite good from a tax planning perspective. And that was on the assumption that these trading company shares could pass with no inheritance tax, but beneficiaries would receive the shares with a capital gains tax base cost at their value at the date of death. So if there were to be a subsequent sale, that's very, very tax efficient, and potentially that those shares could be realised with almost no tax. So going back to the previous example, exactly the same values. We've got trading company shares worth 30 million that qualify for business property relief, other assets of 5 million. So what does Mr. A's inheritance tax liability look like now? So we can see, well, you can see, I can't because it's covered by this bar. Here we are. We can see that the total inheritance tax liability attributed to Mr. A's estate is now £7.5 million. Now, the most significant point to note here is not necessarily the quantum of that liability, but that 7.5 million, to state the obvious, exceeds the £5 million of assets that Mr. A holds outside the trading company. So in this example, as with many, many client situations that we're seeing in practice at the moment, the inheritance tax liability attributed to shares in the trading company can often exceed the wealth that an individual holds outside the business. And this puts into stark perspective the risk to businesses now, because it's always inevitable that many businesses will be called upon to fund these inheritance tax liabilities if shareholders pass away. There was a consultation published in March which proposed that the government remove any conditions attached to the eligibility for an instalment payment option for inheritance tax. So what this means is if you hold shares that qualify for business property relief, you will automatically be eligible to pay that inheritance tax in 10 annual instalments rather than the usual deadline of 6 months from the date of death. So in this example, if we just look at the tax attributable to those shares worth 30 million, we're looking at funding a £580,000 liability annually. If no planning is done, then it's likely the way to fund that will be to distribute that money from the company. So we need to gross that up for income tax due on that dividend. That means that the company needs to make a pre-tax profit of over 1.2 million, pay the corporation tax, pay the income tax on extraction to fund that £580,000 a year. It's a really, really stark risk when you start to gross up the numbers for these costs of extraction. I'm not planning to go into any detail around the rules to qualify for business property relief on this call. I think there's a fair working assumption that most trading companies that are unquoted will qualify, but there are a few key points to look out for. So the holding period of 2 years is important. So for new shareholders, you do need to be careful about this, and particularly if you're transferring shares during lifetime, because you will always be restarting that 2-year holding period. Certain activities are excluded, and the most common ones we see are property companies. Property development companies need to be very careful because there's a sort of grey area around the BPR qualifying status. But generally speaking, most UK, well, all unquoted trading companies will qualify. Just because your company qualifies doesn't mean that BPR will apply in full. There can be some exclusions to that relief. So we refer to these often as accepted assets. So these are assets that are not used for the purposes of the business or are not required for the future use of the business. So again, commonly we see things like properties on balance sheets that used to be used for trade and are now let out. Things like that might not qualify for business property relief, depending on how they're structured. So we do need to watch out for that and make sure that you sort of have a hygiene check of the business property relief status before you look to progress planning in this area. For businesses on a road to exit, it's probably worth noting that commonly the sort of commercial considerations around cleaning up the balance sheet and making sure that only core trade assets are there are quite similar to those which we look at for business property relief. So the two can go hand in hand quite nicely. So I think the illustration that I shared clearly demonstrates, as many on the call will already be aware of, that this is definitely an issue for businesses, not just for shareholders. And I'm talking now to CFOs as much as I am to shareholders. It should be on all agendas of privately held trading businesses. But the good news is a managed succession strategy can significantly mitigate the risk of these ideas, of these changes. There are a number of ideas to help mitigate the risk. And for some, this is accelerating conversations that are difficult to have, but arguably should have been had between family shareholders. It's a very difficult conversation to talk about your own demise or the demise of others and what that might mean for businesses or for families. But actually, this is bringing to the fore a lot of conversations that are probably quite healthy for the overall success of businesses long term. So what can you do? So the starting point has to be to understand and quantify the risk. Like I say, there is £1 million allowance for any given individual. So for some shareholders, that £1 million allowance may cover a significant part of the value of their shareholdings. Valuation is really key to this, and understanding how shares are valued for inheritance tax purposes is very important. That could be quite different to a commercial valuation for those shares. So to understand the potential discounts that could apply for inheritance tax purposes will help keep these risks in perspective. So assuming that there is inheritance tax exposure as a result of these rules, what do we do next? So the answer is not always just to give the shares away or to put them in some other kind of vehicle like a trust. I will briefly introduce these ideas, but I think it's very important that people don't have a knee-jerk reaction to give things away. So for younger shareholders, making sure that they have a goodwill in place that's appropriate, and potentially some life insurance or some insurance at the company to facilitate a share buyback could be quite a simple and easy step, particularly if the exposure is not that significant. Many CFOs are thinking about the feasibility of funding minority buyouts in the future if they have a large diversified shareholder base who may just need small top-ups of funding, and then what that means for the company's funding ability and the liquidity of the company when you come to those points. For older shareholders, the inevitable is it is more important to engage with a succession plan sooner. While none of the rules around lifetime gifting are changing, there is a time limit on the potential opportunity to transfer shares that qualify for business property relief into a trust. So for shareholders who think at some point in their life they may wish to consider a trust as a vehicle to hand over ownership in a very controlled manner to future generations, it's really important that that's being considered now. That's because after April 2026, business property relief will only apply at 50% to that value in excess of £1 million, and a transfer to trust is immediately chargeable to inheritance tax. So for those with large shareholdings, they'll have an immediate inheritance tax liability on setting up a trust post-April 2026. So we've got another quick poll now, just to gauge the extent of action that people have already taken in relation to these rules and where you might be on that stage of the journey. Aaron, would you mind just reading back the results? Because I don't seem to have visibility of them.
Yeah.
Thank you.
Okay, cool stumps there. So we've had about 10% of the people on the call have taken advice and are implementing a plan, which is good to hear, but probably, I guess, reflective of the broader population, certainly that we're seeing as well. And I guess you're the same, Rachel. 24% not applicable. So I guess, yeah, that means in the middle there are 66% of people that are at the early stage of exploring options or have not taken any action to date at all.
Yeah. Thank you, Aaron. And again, sort of well done to those that are already at a future stage of this. I think, you know, as you'll hear further from Aaron, and as we are very well aware in all our conversations with shareholders, these are major decisions for a lot of shareholders, and they are not decisions to be rushed. As Rachel alluded to at the beginning, lots of these conversations are throwing up in the air assumptions about how a business may be inherited in the future and leading to quite different potential outcomes, which we'll come on to in a moment. You know, these are not decisions that you want to be rushing when we get into Q1 next year as we approach that April 2026 date. We need to be thinking now and taking time to be well advised and consider decisions with the number of stakeholders that are going to be applicable to these decisions, whether they be in the business or the family. So again, I'm very conscious of time, so I'm not going to say a lot on this slide. This gives you a little bit of a comparison of the implications of direct gifting versus a transfer to trust. All I would stress here is that trusts are not as broadly tax efficient as they used to be, and there are certain periodic inheritance tax charges that apply to trusts. However, they are a really, really powerful tool at this point in time, because for shareholders who may want to remove value from their estates for inheritance tax but are not ready to relinquish control of the shares, trusts are probably one of the only vehicles that enable that control to be retained in some extent as a trustee, while transferring economic benefit to another generation of the family, for example. So, you know, these could very well be a powerful vehicle for those who are not quite ready to give up full control, but acknowledge that they need to do something, or perhaps to buy some more time to make those final decisions about who exactly gets what through a family. I imagine that most of you on the call are much more familiar with these options, so I'm just going to move straight on to thinking about other options where we may have shareholders who want to get rid of shares, or certainly want to get rid of a degree of value attached to shares, but are not ready to make a completely gratuitous transfer of those to another generation of the family, because quite understandably, they may have spent a very long time building this business all their lives, and they want to reap the rewards from that, as well as passing on ownership that may, you know, transfer management responsibility as well as ownership. So something that we are seeing being a very popular option here at Grant Thornton is the idea of a sort of family MBO. Now, probably a number of you are very familiar with management buyouts as a way of transitioning ownership to key management in the company, and this can be done alongside it. But it's really, for me at this moment, just an introduction in case the concept of handing on the ordinary shares, control and future value of the company is attractive while preserving some value. Again, you know, this is not entirely straightforward, and I'm certainly not intending to go into lots of detail on this, but very broadly, if we have a group of existing shareholders, there is a facility whereby they could be issued with shares in a new holding company, typically a preference share, so it's really much like a debt that they can call on for capital redemptions, can provide a source of income, and that preference share could be something from a very small amount to the whole of the value of their existing shares. And then the rest of the value will be then represented by shares held by the next generation of the family. So these may be adult children working in the business, and that split of value of the business between the exiting shareholders and the continuing family shareholders can be tailored to suit any family circumstance. But it does give the existing shareholders still a connection to the company and some stability, both in terms of capital value and potential income yield on the preference shares that they retain. So I think handing on ownership in some form doesn't need to be an all or nothing. And there are various solutions, this not being the only one, that can do a sort of halfway house, as it were. Another solution that we are seeing become increasingly popular over recent years, which again, I imagine many of you on the call are familiar with, is an employee ownership trust. I think the headline of an employee ownership trust that is very attractive to many shareholders is that it can facilitate a disposal free of capital gains tax. So what happens here? We have original shareholders who sell their shares in a company to an employee ownership trust. They have to sell a controlling stake. That might be financed by way of a bank loan. It may be financed by way of debt to the original shareholders, who, the original shareholders could walk completely from the business and sell everything, or they could retain up to 49%. It's typical to see some sort of management incentive alongside that. But actually, an employee ownership trust has turned out to be a solution for two businesses that I'm working with at the moment, where the conversation started with risk presented by business property relief. But actually, as you walk through the different stages of considerations around shareholders divesting themselves of value, what that led to was a realization that the assumed succession plan perhaps wasn't suitable for the business. The next generations actually want more value off the table, not the burden of running a family business. But for various reasons, a management buyout's not suitable. This has the benefit of the capital gains tax-free exit. It can be a very, very attractive solution for the right business if the value is right. But lots of tax and commercial issues to work through. But it's worth noting that an exit doesn't need to be a full exit again. So I've rattled through those slides. This is just a taster of what is a very deep and high risk issue. And you won't be surprised to hear this is almost all I've been doing with my shareholder clients since the announcements at the autumn budget last year. I think the key message to reiterate is this is a risk that can be managed with due consideration, but it will invite quite difficult conversations in many situations and decisions that are not easy to make. And that's in the large because all those decisions need to balance interests of existing shareholders, their families, the business, and key management of that business. So the right answer isn't always the same for all. And you do need a strong advisory team around you to help walk through those issues, chair conversations, and find solutions that are, most importantly, commercially appropriate for the various stakeholders and meet their objectives, but they're also structured in as tax efficient a way as possible. So I think on that note, Aaron, if you want to take control, I can hand over to you to talk a bit more broadly about some of these solutions.
Yeah, thank you. I can't, there we go. Hopefully you could see that, Rachel.
Yeah, that looks good.
Super. Yeah, so hi everyone, Aaron Baker here. I work in the investments team at BGF. I've been here for about 12 years now. And prior to that was a banker, and prior to that was an accountant as well. So a dangerous combination of a little bit of accounting and tax knowledge. I'm going to sort of build from Rachel's presentation, actually talk about some of the broader considerations when thinking about succession more broadly. So as well as the various sort of family scenarios we've just talked through, actually the broader impact of other stakeholders in the business that might have an impact on the decisions that are made, but also some other options that we are seeing pop up as these issues are getting talked around tables in terms of what shareholders might want to or could also do with their businesses and the shares in those businesses. So sort of a headline level, succession considerations. So actually sort of thinking about, it's not just about who ends up with the shares of the company and who runs the company. Fundamentally, there's lots of different hats to be worn here. Maintaining business continuity, super important to many business owners and founders and management teams, both in terms of their duty of care to their employees, but also their suppliers and their customers. and changing shareholders or changing management teams or passing it to the next generation will have an impact of some degree. It could be positive, but understanding that as we go in. We've talked a lot so far about protecting the wealth that's been generated to date, as well as starting to think about how actually, potentially some of that wealth might want to be crystallized as well. So managing, both inheritance tax from a passing generational wealth through the family is important. But actually, if there is plans to extract value from the business, the broader set of tax rules are super relevant as well. Certainly from a business sale, from a share sale point of view, capital gains tax is relevant. So when we talk about potential MBOs and that type of stuff, capital gains will be at play. But likewise, that when we talk about the risk of the need for individuals to extract cash from businesses going forward to pay potential inheritance tax bills over that 10-year period, this is all based on today's tax rates as well, and they may change. So understanding sort of where that might go and how that aligns with the timelines of other stakeholders is super important. But I think the most important issue is actually just the wide array of individual dynamics around the table. Sort of talk a lot, and it's easy to start conceptualizing some of the potential plans to manage inheritance tax from the eyes of a majority shareholder, but there are tons and tons of businesses out there with multiple shareholders, very often, and certainly in the new world, shareholders that see things very differently in terms of risk and reward appetite. You've also got management team and their view. That management team could be the family, that could not be the family, and what they might do. You might have a second generation family business that are not interested in running it, but have got a say in what happens to that business. So there are tons of individual circumstances that need to get on the table pretty quickly over the next very short period of time, just to actually try and start to find some alignment. But one thing is actually clear, that the tax landscape is changing. There's lots of indicators that it may change again. There's definite benefits in terms of at least securing some of the options that are available at the moment of doing things in the short term. But the risk is that they will invariably get worse from a tax perspective. So getting ahead of it is important. I think we've talked about this already, that the sort of the tax backdrop. Doing nothing used to be a safe option. If something bad happens, the shares would pass to the next generation of the business. There would not be an inheritance tax burden. We clearly know that that's likely to not be the case unless they go back on where the current trajectory is. So actually being prepared for that option and trying to minimize the impact of it from a tax perspective is as we've talked about, has to be on the agenda now. But I think that the general view from us is that sort of stuff, whether it was tax driven or not, should always be on the agenda anyway. And so the presentation will highlight the impact and the importance of having a plan for the worst, but also having a plan for potentially for other options regarding growth and value creation of the business as well. So I think we again, to re-emphasize, delaying planning now, is just going to lead to a higher bill than you would have got before. And so getting ahead of it is super important. Important to protect the value that's been created to date, to ensure that continuity that we've talked about already, and to avoid potential conflict in the business. There's clearly going to be examples where somebody unfortunately meets their demise at the wrong time. The planning isn't in a state, and the new shareholders of the business may see life very differently to the management team of the business, for example, and or just need to extract cash to make those inheritance tax payments. And that conflict that may exist between the new a current management team working under a founder and that current management team working under the founder's next generation could be serious. It could be a complete misalignment. They could not get on. And then fundamentally, as well as the individual that's been handed some shares having an inheritance tax bill coming in every year for the next 10 years, that management team might be disincentivized because they haven't got the cash to do what they want to do, or there's too much cash being dragged out of the business, or any equity incentivization that they've got to motivate and align them is underwater, from the day after the death, and could actually drag value over the years, from the company. So again, just highlighting some of the broader impacts of actually doing nothing could have on not just the cash impact, but actually the total value that the family or the broader estate of family might have to play with. we talked, Rachel talked briefly around sort of, passing assets early, losing control. So things like trusts, etc., allow a stepping stone for that. There's also the capital gains tax increases. We've seen capital gains tax go up already. It's due to go up a couple of times over the next few years. So actually, as well as the broader considerations around potentially wanting to pass the business through the generations, actually, it may get to a point, given broader demographic changes or circumstances within individual businesses, that they might want to sell shares as well. And actually, if that is a possibility, again, it's something to think about sooner rather than later, because if purely from a tax perspective, the amount of tax from a capital gains perspective you are going to pay on the sale of those shares is likely to go up as well. So again, as well as all the inheritance tax stuff, across the board, there are going to be increases in the cash that goes to the taxman rather than the estate of the individual and their family, or of the shareholders. So again, it just highlights the need to be bringing forward these conversations around what the future might look like. I think it's super apt as well, given the actual economic backdrop that we've been in. Since arguably since 2016, we have been under sort of one serious economic impact or another, from Brexit through COVID, through Ukraine, and then more recently the inflation aftermath and some of the market stuff that's been going on since Trump took control in America as well. And what we are seeing from this side is a lot of misalignment at a shareholder level. So again, very different to if you're a founder, 100% shareholder, it's your way. But actually, businesses where there might be co-founders, or there's legacy investors or legacy family members who actually just are seeing things very differently, and some want to get off the train and some want to keep going. And actually, what that is invariably doing is holding businesses back, and it will hold businesses back because that decisions can't be made collegiately. And I think that's because actually underneath the UK, despite the sort of the negative news that seems to be dripping in every sort of month or two at the moment regarding something else that's gone wrong in the global economy, there are signs that the UK is looking like a better place to do business again. We are comparing favourably versus Europe. We are comparing favourably versus the States at the moment as well. And I think fundamentally we've got a bit of a coiled spring in the economy that's waiting to unlock in terms of going and grabbing growth again as we come out of a reasonably flat economic period. So we are seeing that, I guess, the more entrepreneurial end of shareholders and management teams actually saying, well, now is not the right time to go, even though the tax is going to get worse for me, because there's actually, there's more value to go after, or there's more of my aspiration that I've always had to go and execute. But actually, the job there is to actually sort of manage all of those dynamics and try and align the business, align the shareholders for what it needs today, position it for tomorrow, as well as trying, to the extent possible, minimize some of the increase or the likely increase in tax bills that will come off the back of it. So we've talked quickly there around some of the different motivations. Sort of the way I always approach this is sort of the three hats. And I will stress that, an individual in a business, if they have founded the business, could be wearing all three hats, but they will actually look at things in different ways. Shareholders will be lots of different reasons as to, why shareholders want to sell their shares or hold their shares or sell their shares. It could be, wanting to keep it in the family. It could be waiting for the right time to sell the business in the market that it operates. It might be that they need the dividend income. It might be that they think it's going to be worth tomorrow. Finding alignment on all of that is is almost the first place to start here. Actually getting the view from everybody around the table in terms of what they want to do and why they want to do it will start that education process for you and your advisors in terms of trying to find something that looks like alignment. And that could be, buying shareholders out that don't want it passed through the generation. So you can buy shareholders out so you can crack on with growth, selling because it's the path of least resistance. But there's 1,000 different scenarios in there. But without all the information, you're not going to get there. We talk a lot as well, and this is probably the cynical side of life as well, about businesses passing through the generations as well. But particularly, I guess, if you're the founder and you've built the business from the ground up, there's a bit of an honest conversation to have regarding the value that you have created. If you value that value, are you passing it on to the right custodians as well? Is the next generation good enough to deliver the business, keep the business growing? Are they going to be good enough, but they're not good enough yet? Does that have an impact on your timing? All things that need sort of considering and a sort of an honest opinion and bouncing off stakeholders and advisors that can just walk you through some of that thinking. I think from a management team perspective, a management team could be second generation. It could be a third party employed management team. They will have their own agenda as well. Hopefully they are entrepreneurial and they've got plans for the business and what they would do with it if they had the keys. That, as a shareholder, will give you more options, because things like MBOs and EOTs and private equity come onto the table if you've got that sort of management team. Likewise, you obviously you will need to back your family if you're going to pass the shares down the generation as well. But again, broader things need considering there as well. Incentivization, job security, for some people, those things are sometimes more important than owning the shares. And again, understanding the individual drivers as to what's keeping them there and, almost what might make them leave is super important. I think it's very relevant. There's a lot of talk around sort of restructuring businesses and family MBOs and EOTs and all that sort of stuff. Invariably, that involves leaving some wealth in the company that gets paid to you over a number of years. So in a lot of circumstances, you're actually relying on the business and its new custodians, whether that be a management team, a family, or whatever, to actually, keep running the business to generate cash to get you repaid as well. So you've got to be really confident in terms of, who is effectively looking after your investment, your deferred debt. And then the third box there just talks about the founders that may be driven by different things. That might be leaving a family legacy or leaving an impact in a market, or, fundamentally what they set up the business to start with. So very quickly, because I'm just conscious of time. So I think Rachel probably covered a lot of this, but sort of three big buckets that I wanted to talk about. The sort of as you were bucket. So passing to the next generation. We've talked about the risk of inaction and the need to get ahead of some of this stuff. On the right there, I've mentioned some key considerations, which again Rachel's touched on. Reviewing ownership structures. Could the shares be transferred during the lifetime? Could you gift shares now? Can we get trusts in place? That kind of stuff is all live tax planning if there is a clear plan that you as a founder want to keep passing the business down the generations. Shareholder agreements are super important at this stage as well. I think from a general business point of view, as well as when you're going through succession, just so it's really clear what your plans are for your shares when the worst happens or when anything else happens. And having that set in stone is important, but it can also cover things like buybacks and valuation mechanics and that kind of stuff as well. So again, with the right planning for all the different scenarios that might happen in the future, you can make sure that something's written that your wishes are effectively delivered by the company. Talk at the bottom there about, I guess, a second option, which is, we see this quite a lot nowadays, sort of the business being passed to the next generation, but then who knows, they might sell it, they might not. And I guess if you're sort of mum or dad and you founded the business, you might be sat there saying, well, if I knew you were going to sell it in 30 years, I wish I'd taken some cash on the way through. So we are seeing, and BGF, it's obviously what we do, is actually that supporting that succession. Allowing mum and dad to take some cash, supporting their children or whoever else it might be with the succession of the business, helping manage that succession, minimizing tax where possible by utilizing other tax advantages like entrepreneurs relief and that kind of stuff to sort of minimize the tax through the way. But with an underpinning of actually sort of driving value for the next generation when they decide to sell or not as well. But again, a lot of considerations in there, a lot of different agendas and a lot of different outcomes. So again, getting it all on the table early is super important. So bucket two is sort of, faced with all of this, not sure what it might mean for the kids, not sure what it might mean for the business going forward. Why don't we just sell? Which is absolutely valid. A lot of businesses get sold every year. I guess key considerations, again, getting a clear vision whether this may or may not be the right option right now. We've talked about capital gains tax. That's likely to go up. It's going to cost you more the longer you wait. But actually some of the other stuff's way more important. And I guess if you're sat there as a shareholder, you wake up to tomorrow and say, I can't be bothered anymore. It is not just as easy as selling your business most of the time. You can get lucky. But, there are lots of considerations to play. Is your business sellable in the current market? Are you going to get the right price in the current market? Is your management team capable of running that business without you? All those sorts of things are going to impact how much cash you get. And actually, the further ahead of those sorts of considerations that you get, the more value you're going to get, but actually the more optionality on timing you're going to get when it comes to selling the business as well. But the other half of, of selling a business is the opportunity cost of it as well. It's the risk of, are you selling too early? Are you leaving growth at the table? Is it the wrong point of the cycle? Are you selling today because you need the cash or because you want to lock in today's tax rate? They might not necessarily be the right reasons to sell today. They might be the right reasons to think about selling today. But actually, can you offset some of the increased burden that you might hold or the next generation might hold in terms of the pound coins in their pocket by actually growing value and creating it back elsewhere? Just again, stuff to put on the table. And then we talked there, I think I've mentioned it before, around deal structuring, sort of, deferred debt, you leave debt behind or you leave preference shares behind in the family MBO model. That needs funding. That is a burden on the business going forward. That is a burden on the management team or the second generation to repay that. And it needs to be a pretty honest conversation with them so they understand, what they are taking on, because many won't want it. And, you would expect in a lot of those situations, the appeal is the fact that they get their hands on the shares, which is great. But if they can never see value in those shares because the business doesn't generate any cash anymore or can't invest in growth, that's when misalignment's going to start coming through. We're seeing quite a lot now of well, not tons, but we've seen quite a few EOTs that were done 3 or 4 years now, where management teams are starting to get frustrated because effectively all of the capital in the business is repaying the owners of the business, which is absolutely right. They need paying for their business, but it's inhibiting strategic investment in the business. And, that's a scenario where you sort of talk to some of these management teams and they say, well, we wish we'd taken on a little bit less debt. We give them a bit less cash at the time, a little bit less cash on the way through, because actually we could be a bigger business now. And those sort of subtleties in those considerations are very relevant because they impact everybody around the table. And then bucket 3, and it's sort of, I guess, bringing it to BGF effectively. What we do, growth capital minority transactions, is actually hopefully that ability in the market to do a bit of everything. So BGF, we can buy some shares off founders. We've definitely got dozens and dozens of examples where we've supported that succession from mum and dad to son and daughter, allowed mum and dad to have some cash, to not have to worry so much because somebody else is around the board table that's been there before, but also manage that succession from a family to a non-family shareholder dynamic as well. Kids aren't interested. I founded this business. I've got no idea how to find a CEO who can do my job, who can take it through and get it sold, who can, give me the cash in the future. So bringing in somebody that can sort of facilitate with all that strategic stuff that needs doing, but can actually, buy some shares off you at the start to effectively allow you to start enjoying the fruits of your labor. But again, also lock in some of the tax rates of today, which, if we're being honest, are probably only going to get worse tomorrow. And I think the other sort of aspect of, I guess, raising capital as well, and we've talked about it, is just this need for, if something does happen or you haven't planned appropriately, we are fully expecting businesses to sort of look and say, well, we actually just need to generate more profit. We need to generate more cash per year just to stand still. Most businesses can't do that at the drop of a hat. Otherwise, you would hope they would be doing it. So we're expecting as well, businesses to actually be in the market who have fell into that trap or have had to absorb that extra burden on the company because that's what the shareholders want, to actually need to go and raise some capital to invest, to become more profitable, to get bigger, to generate more cash. And again, you're going to need to find funders that want to support that. But fundamentally, those funders are going to want to return as well. So what it does do is it adds a stakeholder to the mix, and I guess arguably, another person that around the table that needs that alignment needs to be found with. But hopefully, the right funder with a checkbook that wants to work with everybody can actually use cash and experience to manage some of those alignment issues. So, brief overview around BGF. I think I've just highlighted it there. We provide minority investment between 5 and 30 or 3 and 30 million pound into UK SMEs for lots and lots of different reasons. But fundamentally, it's to unlock growth. And we very, very much see finding alignment around the table, as a reason to write a check. So that could be buying out non-relevant shareholders that are stopping investment decisions. That could be buying out mum and dad because that's what they want in order to unlock the business. That could be to support planned succession, as we've talked about here, all the way through to to stuff outside the shareholder base as well, sort of mergers and acquisitions, capital expenditure, international expansion, etc. And I'm conscious of time, so I will call it a day there.
Thank you very much, Aaron, and thank you to Rachel as well. I've been collecting questions as we run through. So Rachel, perhaps first we'll come to you and I'll work backwards through the question. There's a question on the chat about, and a very fair question about leaving cash in the business to enable the IHT to be funded, and how that might be treated from an inheritance tax perspective in terms of accepted assets.
Yeah, thanks, Rachel. And it's a very valid point that if you hold cash in the business and that level of cash is beyond what HMRC might accept as working capital, then it would typically be treated as an accepted asset, and therefore the value of that cash wouldn't attract BPR when you're looking at the overall value of the shares. There's no solution to that in terms of cash, albeit, you know, what you can accept as working capital is clearly subjective, and the more contemporaneous evidence you can keep about why that cash is being applied for a business purpose or why it might be needed for a future business purpose, the better. There is an interesting structure of a corporate that can be explored where there is excess cash. So I'm working with a business at the moment who has the nice problem of generating more profits than the shareholders want. And rather than store up this problem of a big cash accepted asset on the balance sheet, we're setting up something called a hybrid business for them. And this is where you have a trading business, which is wholly or mainly trading, so it does qualify for BPR. Alongside that good trading business, as it were, you have an ancillary investment business. Now, if there's enough activity around that investment business, just because of the way the law operates, it's possible to bring the value of everything into the scope of BPR without those investment assets being accepted as they would if you were just keeping high volumes of cash on the balance sheet in fixed deposits, for example. So it's absolutely right to acknowledge it's a problem. And the only other thing I would add is it's no worse than distributing it. What you don't want to do is distribute that cash to save it up personally, because you're going to lose sort of best part of 40% of income tax on the way out and only have the net amount to deal with anyway.
Thank you, Rachel. And just staying on IHT just for a second, in terms of how shares might be valued, and thinking here in particular about spices and minority discount, can you just touch on that for a second?
Yeah, definitely. So I alluded to the fact that valuation is really significant to this. And clearly, if you own 100% of the company, your shares are probably worth what the company is worth, albeit, again, as I said, with working capital, valuation is always going to be a subjective art. And it's important that if anyone's getting valuations for inheritance tax purposes, they are getting them from someone that knows how to value things for tax and not commercial purposes, and what that's for. Where things get more interesting is where you don't own 100%, and you then get into the realms of discounting the value of a shareholding, both for a lack of control and a lack of marketability. So if you have more than 75%, you typically won't see so much of a discount, maybe only 20%, something like that. If you have less than 25%, you can be looking at discounts in excess of 50% on the value of shares. Again, it's subjective and there's an art, and it's all based on years of case law. So there's nothing, it's not a prescriptive scale, because it will depend on the type of business and the liquidity of the underlying assets. But there is a lot to think about there.
Thank you, Rachel. Aaron, moving on to you. There's a question in here, and I'm just going to frame it a slightly different way. So I guess when you're looking at investments at the moment, is this coming up on diligence? And I guess the question that leads on from that then is, how open are BGF to things like share buybacks and other shareholders increasing their stakes to try and avoid and mitigate some of the IHT challenges?
Yeah, I think we are being sort of requests for funding are looking at some of this stuff. You know, people are aware of this. So whether it's, you know, I think from a company point of view, you know, as a, you know, pick an example, as a founder who has run the business, passing those shares on to the kids, those kids having influence over the company because they've got votes, etc., that may not be aligned with the company, makes it difficult to raise investment. So actually what we're seeing is sort of, you know, family members where the family aren't interested, looking to pass it on to a management team to go and sort of crack on with their plan are actually saying, well, actually, right, well, we need to realise some cash now. Inheritance tax planning is a separate consideration, but we can start the transfer of assets, albeit it's cash, and start dealing with it there. And move forward. So that's something that we see come up. Share buybacks is, as part of that solution is a route through, businesses raising money to buy shares back for the same reasons effectively. And I guess from the share buyback perspective as well, certainly from minority shareholders or disproportionate shareholders as well, it can be more efficient than paying out dividends, etc. as well. So if someone actually is more interested in the cash than necessarily holding the shares going forward, it's a way through. From an exit perspective, BGF have made quite a few investments into family businesses where fundamentally we've put the cash in to drive some growth, and then absolutely we have been bought back out at the other end. So we have been bought back out in the right circumstances as well. The one thing that sort of everybody needs to be super careful in that sort of situation, particularly if you're talking share value, is as an equity investor, we obviously want the share value to go up. As a business, and you're going to buy it down, you definitely want the share value to go down, and there is an immediate misalignment there actually as well. So just having those discussions up front around how you're actually going to deal with that conflict of interest at the right time needs to be had. But as a route through, absolutely, example I can think of, we put £4 million of investment into a business. It kickstarted some growth. There wasn't actually any, this was a few years ago, there was no sort of shareholder succession there. It generated an additional 12 or 13 million pound of equity value. You sort of, you take away the 4 that we put in, the shareholders collectively were 8 million better off, and we had to work out how to split it. So that's the sort of, I guess, the easy example in that scenario.
Thanks, Aaron. And I guess one of the other questions that's on the chat is a kind of common almost frustration with the changes. And I guess question for you, Aaron, is are you having conversations with shareholders where you perhaps would not have been prior to the changes because of that frustration?
Yeah, I think it's a combination of two things actually. It's that frustration, people just wanting to lock in the today because we've got no idea what tomorrow brings, combined with the disparity in risk appetite from a growth point of view as well. Whereas, from a management, from a board table point of view, some people have just had enough now. It's just like, right, I just need to get out. I need to get out at today's rates because increasingly it might not be worth my time to carry on and grow. I might be tax goes up another 10, 15%. If it takes me another 10 years to grow it another 15%, I'm no better off. What's the point? So definitely the frustrations are accelerating people to say, well, we need to do something now. But as I say, that you've got those macro factors, whether it's the fear, fatigue in some businesses, but then equally, we've been in a disruptive market for some time now. That disruption usually breeds opportunity, so the other half of it is actually some shareholders, some management teams saying, well, actually now's the time to go, and actually encouraging the conversation the other way to sort of say, well, actually, if you're a little bit nervous about what tomorrow might bring, what we can deal with that, we can deal with that for you now. Let us have a go running the business going forward. And that could be management team, that could be next generation.
Thanks, Aaron. I must apologise as well, because there's a couple of people that have had their hands up that I didn't realise. I don't know if either of those individuals are happy to ask their questions if I put them on the spot, perhaps. So if you'd be happy to unmute if they want to contribute. So Chris Thompson, I know that you had your hand up earlier and I did not realise. I don't know if you want to ask your question. We may not be able to unmute you. That might stop that question being asked, Chris. I don't know if you can put it in there, if you could pop it in there, if you could pop your question in the chat, because I think we're having problems. Whilst we're waiting for Chris, Rachel, one of the common things that we talk to people about is, I think people are a lot of the planning that we're talking to people about is around trusts. And I think a lot of people are very scared about trusts because they're not everyday vehicles. So I guess what are the things that are the biggest misconceptions about trusts that we tend to have those initial conversations about?
Yeah, thank you. I think one of the things I commonly hear is I don't want to set up a trust because I don't want my children or my grandchildren to become trust fund babies and lack motivation and lack purpose. And ironically, they're almost the opposite. You know, when you compare a trust to a lifetime gift, all a trust does is give the beneficiaries a potential right to income. You know, I'm not saying this is the right thing, but not all beneficiaries even know trusts exist. If you set up a discretionary trust, all the control still stays with the trustees. So that's often the person.
Oh, have we lost Rachel there?
We have.
Oh, must have been something we said. I think what Rachel was going to go on to say is that you know, often trusts are a way to do what shareholders were going to do in their will anyway. But the benefit of a trust is that they're able to do that during their lifetime whilst retaining control. So I think there are often things about trusts that people are concerned about. And I think it's because they're not everyday vehicles, and perhaps people are having to start to think about them a little bit more now.
Yeah.
I don't think we were able to unmute, unfortunately, Chris, and I think Philip, you also had your hand up, so we will absolutely follow up with you afterwards, so that if you did have a question, you can answer it, and we will work out what. Oh, I think Philip, you have unmuted, have you?
Can you hear me?
You've successfully done that. Please do ask your question.
Yeah, okay. My 90-year-old widowed mother is the sole shareholder of the family company that I run. We're caught by the thresholds. So for every pound of growth that I deliver for the company, she gets after tax 37p, and I get an IHT liability of at least £1 more. This isn't exactly a plan for growth, and given her age, mitigation strategies are not that easy to come by, because the chances of her living 7 years are limited by her age.
Yeah, agree, Philip, and it is a common sense of frustration, particularly at that age of shareholder. I guess it's weighing up the benefit of doing nothing versus doing something and taking that risk, because the tapering does kick in after 3 years for inheritance tax. We have also found for some shareholders where we wouldn't have expected it, actually the insurance has not been as expensive as people might have otherwise thought. But yeah, certainly talking to many shareholders and second and third generation that absolutely share your frustration. And thank you for unmuting yourself to ask your question.
I think that's the important point there, isn't it, Rachel? That's a you know, it's an example. These policies are not helpful at all, and there'll be situations where it's really hard, but if you do nothing, you are definitely going to be worse off than you were. You still have time to do something. You might not get there in time, you might not, it might not sort of bridge that gap back to where you would have been until the rules changed, but fundamentally doing nothing, you definitely will be worse off, so it's better to get ahead of it.
Agreed. Thank you, Aaron. So thank you to Aaron and Rachel and to everybody for joining us. I guess key takeaways, as Aaron just said, doing nothing is now actually not likely to be a very good option at all. I think inheritance tax is an optional tax, and it is possible to plan, but you do need to think about that planning for April 26 because the clock is ticking on some of that planning. And as Aaron has talked about today, there are other options that may be worth discussing. They go all the way from minority investment all the way through to EOTs and everything in between. And the absolute key to that is having those conversations and being open to